In this video, we're going to look at approaches you can use to improve trading win rate, of course, decrease losses. It's one of the key metrics involved that create your trading results. And so it seems worthwhile looking at that. So I'm going to give you a few tips and a few techniques to potentially have a look at. I'm going to make a few assumptions and give you a little overview of some key principles. First of all, to refine and improve results, a good system of recording must be in place. And this must measure metrics such as win-loss rate, average win, average loss, as well as the overall profit loss. And of course, it's worth bearing in mind that profit loss is actually a result of those four factors: win rate, loss rate, average win, average loss. Now, the other important point is the quality of your results is dependent on how well you execute the system. If you don't follow a trading plan, then you can't execute the system properly. So if you are in a position, and most traders are, where occasionally they'll stray from plan, then what you need to do when looking at any sort of performance evaluation is remove any trades that weren't consistent with plan. Obviously, if this is a significant issue for you, we would suggest you go back, review your plan, make sure that you are trading it, and then, of course, you can come back and work on this at a later stage. There's the key point that's going to be emphasized throughout this video and the next one. There's usually going to be a payoff, meaning that if you tweak one component, it's potentially going to impact on another. So this is fine as long as the overall result is improved. But if you aim to decrease losses, there is a potential, of course, that you decrease wins as well. The bottom line is that you want to decrease wins less than you decrease losses. It's worthwhile emphasizing that at this stage. So if we look at improving win rate and remembering that payoff, there are two approaches we can use. We can either increase the number of wins more than you increase the number of losers, or, of course, we can decrease the number of losers more than we decrease the number of wins. There's that payoff. So let's look at a few strategies that can help us do both of these. And it may be one or a combination of these that could potentially make a difference. So let's look at firstly increasing the number of wins more than you increase the number of losers. So the potential approaches with this are as follows. First of all, we could remove some criteria barriers to entry that could be successful. Often we get carried away as traders and keep on adding more indicators and more indicators and more indicators, making our charts look very pretty, but often they don't make a massive amount of difference apart from they put extra filters in place to stop us entering trades. Let me give you an example of this. If you have a rule in your system that says if the RSI is above 70, then don't enter a long trade. It could also take out significant winners of those trades that are on large trend runs. Often we see the RSI stay above 70 for a considerable amount of time before ultimately we see it start to drop off. You can only be sure, of course, that this is the case through testing. Let me give you another example. Let's say that you have confirmation that price must be over 100 period moving average. In principle, that's a good approach to have because it mirrors making sure that there's a longer term trend in place. But is that potential filter to entry stopping some trades which could be very successful, more so than it helps minimize trades which might not go your way? So again, if you like the idea of keeping that filter in place, perhaps have a look at what might happen if you reduce it to a 50 or a 75 EMA. Another approach that we've seen used time and time again with some success is giving a little bit of space for markets to breathe. So not cutting off trades before they have a chance to win. Now, there are a few ways we can do this, but probably the most common is having a less aggressive stop. The next approach we would suggest you might consider is looking at how much you're giving back to the market. So if a reversal pattern is seen on a chart, even if your other exits haven't been triggered, consider taking that earlier. So exit on specific, specified, unambiguous reversal price action. So if you see a 3-bar reversal on your chart with increased volume, should you be exiting at that stage and so retaining more of your profit rather than waiting until it comes down and triggers your system trail? Of course, it's worthwhile emphasizing that the time at which markets move most is when some new information enters the market. So we can mitigate for this by reducing the likelihood of hitting a major risk event with a sudden significant price move. So avoid times in terms of entering trades if there's an imminent data release due that is potentially significant. Your challenge is, of course, identifying which are the significant data points relevant to the instruments you're trading. And of course, you have also the challenge of what do you do with open trades? Of course, you've got three choices. You stay in them and ride it out. You potentially reduce risk by tightening a trail or even taking some off the table with a partial close. Or, of course, you can exit completely. You need to do some work in finding out which of these creates a better number of wins more than you increase the number of losers. And as I said before, remember there's a potential payoff with every intervention you make. If you see your win rates drop from 75% to 70%, that might be okay if your average win in dollar terms is better. Of course, we're going to cover that in the next video. The second part of this is to try and decrease the number of losers more than you decrease the number of wins. So, in the same way that we did previously, let's look at a few approaches that you could consider. We could add additional signals that offer some confluence. For example, a confirming indicator such as volume or agreement of other price action from an alternative time frame. And this doesn't have to be necessarily higher. There's a school of thought that suggests your move is first seen on shorter time frames. So look at both lesser and greater time frames to see if there's a pattern there which gives a higher probability entry. Things like candle structure are really important. If you consider the nature of a candle, you might have a breakout through resistance, but if that candle had closed in the bottom third, it suggests that potentially the bulls didn't win that candle, and hence the chance of a false breakout from a probability point of view is increased. So perhaps something like it's got to close in the top third or higher than open price, which means it closes in the top half, is a worthy thing to consider to avoid false signals. Time of day is often important. We can remove times where winning trades are less likely, or losing trades are more likely, of course. Specific times of day, or even days of the week, or even different seasons. On a simple level, an example of this might be to look at how your strategies perform, perhaps on opening times of the various markets. So, how do they perform at the start of the Asian session, the European session, the US session, where things are more volatile? Or perhaps they perform better during that time. It's quite easy if you record it, of course, to determine which days of the week. We've found, for example, one of the NASDAQ EAs that we use works really well on a Tuesday, Wednesday, and Thursday. But on a Monday, it doesn't work so well. But we would have only seen that if we checked in on and recorded how it performed on a day by day basis. Again, and relevant to a point raised previously, we need to give markets the space to breathe. So we don't cut trades off before they have a chance to win. Obviously, much of that is often psychological, particularly if we're trading after a succession of losses. But also, more generally, we can reduce the aggressiveness of trails by increasing an EMA for 10 to 20. Again, it goes back with starting with a base point and then comparing the alternatives. And that what if analysis is really easy to do if you've recorded your trades well, not just recorded the profit loss. And of course, we can balance that out by doing things like moving a trail stop to above a break even level, automatically meaning that that trade will end up in profit irrespective of what happens next. This is a common technique that we've utilized with a partial close. So not only perhaps do we close half the trade down when it's 2/3 of the way towards its take profit, but also rather than just leaving the stop where it was originally and potentially giving away all that profit, we'll trail that stop up to above break even. So the two parts of that trade both end up in profit. So there's just a few approaches that might help in terms of decreasing the number of losers. Combine that with what we covered before in trying to increase the number of winners, and you could see some significant improvements in win rate. Of course, these factors need some additional research. Hunt them out. Make notes in terms of what you're seeing, and you'll be in a better place to ask the right questions and meaningfully test those things which look as though they might have some impact. So your actions from this video is to consider the content in these sessions. Of the few approaches that we've discussed, which of those do you think may contribute to your trading? And of course, it's not just about thinking, this is about doing. Make sure you subsequently take some action, even if that start point is to make sure that your recording of what happens in your trading is better, and then do that what if analysis on trades that have happened before. By doing this, you're making the choice to potentially create a better trading future. It's up to you. I hope that's been useful and given you a few things to work on. Trade safe and see you again soon. Bye bye for now.